Well, good afternoon, everybody, or good morning, depending on where you're from, where you're at, where you're listening to the Snowbird Expat Radio podcast. I have Sharon Conrad with us today, and she is with Hanson Crossborder Tax, and she is one of our partners that we rely on heavily when it comes to cross-border issues and having another expert on our podcast. And once again, I apologize. This is for expats up here that moved to Canada. A lot of the conversations we're going to have is going to deal with our friends, the Americans moving to Canada. I do apologize. We do have a show coming up. And Sharon, I think you know David Lazan. He's from
Yes.
Buffalo. He is an estate planning lawyer from Buffalo. I had lunch with him last week in Maui at Mama's Fish House, and we're going to have David on the podcast on December the 20th. So
Well, that'll be an interesting
I
one.
it will be very interesting because there's lots to cover, and this podcast is becoming so heavily weighed towards expats, and I encourage people to call in and give us some ideas for how we can help the Canadian snowbird audience and provide them with some great tips. So Sharon, welcome to the show, and thank you for your time. And
Thanks for
like a
having
lot of
me.
it, yeah, have it like a lot of accountants that tell us a little bit more about Hanson Crossborder Tax, and then we're going to get into some really technical stuff today. So I do apologize for those snowbirds, but we are going to be covering some issues for expats. Tell us a little bit more about cross-border tax, Hanson Cross-border Tax.
So Hanson Crossborder Tax is a private boutique firm. We're in Oakville, Ontario. We've been around for about 7 years, and we focus exclusively on Canadian and US tax issues. So our clients are diverse from, people that are just relocating to the US or Canada, executives, athletes, entertainers, estates, high net worth business owners. If you have a dual Canadian US reporting requirement, then and the more challenging it is, the more interested we are. So that's what we do 365 days a year.
And you don't take any breaks for Christmas or Easter or birthdays or
I don't, but we do. We do close for some of the holidays. We have to give everybody a chance to recharge. But yeah, it's not just a seasonal business. We're here all year, and believe it or not, I mean, when you're dealing with two different jurisdictions with different laws, every day is busy, and no 2 days are the same.
Well, like a lot of entrepreneurial people, sometimes Christmas, birthdays, and Easter become more of a hassle because we do tend to be very busy. So you mentioned you're a boutique firm, and tell us more about your professional career because I know a lot of people that do come to the realization that it'd be better to serve clients in a boutique rather than the bigger firms. You did have some experience with, I think it was KPMG, and also Deloitte. So tell us a little bit
Yes.
more about your professional career.
Sure. So I'm actually a maritimer. I started my career over 20 years ago in Halifax with KPMG. Started right at the entry level tax technician, learning from the ground up U.S. tax and Canadian tax. So I've been involved with it for all my life, all my professional career. Um, and I've slowly moved into the personal tax area, while I had a background exposure to corporate work. I tend to like working with individuals more. So I do a lot of mobility work, retirement planning, estate planning, and also dealing with executives and equity compensation. When I made the move to Deloitte, I then transferred to to Southwestern Ontario and worked there for several years before making the move to sort of private or the boutique firm where I could focus on tax and I didn't have to be worried about all those auditors and all that accounting, all those accounting rules. So it was a nice change to kind of break free from that big corporate structure and really get in touch and deal with clients on a daily basis. It's great when I can put their mind at ease and let them sleep easy at night.
If that's possible with cross-border
Yeah,
issues.
I try,
Now,
but
one
no
of the,
guarantees.
and I do apologize because I just kind of rolled back a little bit and I crossed my legs and I almost exposed the fact that I have my wife picked out a really nice shirt from me today, but I have shorts on because I'm in Maui and I'm almost exposed myself with my shorts. So I do apologize. But, one of the first questions we have today is we know that a lot of these Americans that come across to Canada, their employer has either granted them RSUs or RSAs. And I apologize, I'm using acronyms here, but Sharon will point out the differences, what is an RSU and the difference between an RSA. So we want to hear your wisdom here.
Yeah, I have a lot of clients from the tech industry, and equity compensation is very popular form of remuneration there. And most of the clients that I speak with a lot of them are coming back to Canada after being in California for a number of years and have a lot of these different equity assets, right? And a lot of them really don't understand what the terminology means or how they're taxed. And so part of what we do is try and educate them on that. You mentioned restricted stock units, which is RSU, and restricted stock awards, which is the RSA. A lot of people use the term restricted stock interchangeably, but it's a bit dangerous, especially when you cross the border, because the RSU and the RSA are different, and they are treated differently north of the border. So there are situations, particularly where you have U.S. citizens or green cards holders that are moving to Canada because they still continue to have that U.S. reporting requirement. So if we look at what an RSU is, it's a type of what they call phantom stock award or stock option, and it can be settled in one of two ways. It can be cashed out, which is common, or it can be settled in stock. And what it is the unit is pegged to the stock. Usually it's on a stock exchange, but it is pegged to the stock. And so that's why typically, unlike a stock option, there's no cost to acquire the restricted stock unit. So they're usually vesting on time. So common is 3 to 4 years. And then, once they meet that time requirement with the company, they either get paid out in cash or in stock, and it's considered what we call a full value award, meaning that you're going to be in the positive regardless, because there's no cash outlay from the employee. The restricted stock unit is full. Of course, you have to account for the taxes as well, but the restricted stock units are fairly common, both sides of the border, and they're treated the same. There's one, the Canada Revenue Agency recently came out with an administrative position, an interpretation regarding how the restricted stock units are to be sourced. And that's a different concept than just having that employment income. And so there is a bit of a disconnect between how the US does it and how Canada does it, which could impact foreign tax credits. So that announcement came out within the last year. So those individuals that are responsible for writing those programs need to be careful on the wording when it comes to the vesting period. The restricted stock award is different in that instead of just getting a promise for cash or stock, you're awarded the stock up front, right? And then you have vesting conditions. So, you have acquired the stock, you just can't transfer it, you can't sell it, it's just sitting there. But typically you have voting rights and you have you have entitlement to dividends as well. So those are the two sort of restricted stock awards that we have. And the difference with the restricted stock award, or the RSA, is that in Canada, those restricted stock awards are taxed at grant, and in the United States, they're taxed at vest. So there is a timing mismatch. And if any of the expats out there have received a restricted stock award, the term 83B election has probably been thrown at you. And really all that is, it doesn't really have any impact from a Canadian standpoint, but what it does is it mirrors the Canadian treatment and allows you to be taxed at the award point, when presumably the cost is nominal, and then anything after that would be considered capital gains. So the timing of the recognition of the taxable event then matches Canada. So that's one question I get a lot with respect to the restricted stock awards. But you'll see in Canada, the restricted stock award is not as popular as in other countries. We tend to stick with the stock option or the restricted stock unit.
Now, is one becoming more common than the other? An RSU?
Yeah, the RSUs are becoming a lot more common for a few reasons. One, it's a little easier to administer because the vesting dates are preset, right? They're usually based on, an anniversary date. Stock options are typically, it's at the leisure of the employee when they want to exercise the option. So you get into a little bit more of administration. You also have the cash outlay that's involved with the stock option. In recent years, a lot of stock options have gone underwater, so that's been a big issue as well. So the restricted stock units are effectively, it's a bonus program, right? It's a bonus that's linked to the stock of the company. And it's relatively easy to administer, especially if your company is on a stock exchange. You would get a third-party company like ShareWorks, for instance, to manage and administer it from a financial point of view. The restricted stock award is less common. You see that a lot with startups. People tend to call it like founder shares. But restricted stock awards typically aren't popular in Canada, and they're getting more rare in the United States too.
So let's say I'm an Amazon US employee. I moved to Canada. I've got these RSUs, not in my back pocket, but with the with the CompuCenter or Computer Center or whoever that third party administrator is.
Sure.
How are those taxed, those RSUs? So let's say they're not invested. All of a sudden now I'm in Canada, they're invested, and that's the time that it's rewarded and it's taxed. How common is that?
It's very common. The border, now that, for that brief period during that I'm not going to mention, there wasn't a lot of mobility, but the mobility is back, right? And we're so close to the US. There's a lot of employment related travel across the border. We could have a whole other podcast on that. But when you're looking at something like an RSU and its employment income, we have to look at where you're physically delivering the service, right? So it's not, oh, my employer, my payroll is in the United States, or, it's a US company. It's basically where you, the employee, are physically rendering your services as an employee. And so you're going to become, if you're mobile across international borders and you have equity, you're going to become very close friends with your payroll and human resource team. You want to be very nice to them, and because they are going to be a big part of your tax filing. The reason why is because you have to track your work days. And from a sourcing perspective, the country where you are physically working gets to tax you first. So they're the country of source. And then, for, let's say, an American in Canada, if that income is Canadian source, then in the US, you would get the foreign tax credit. What happens is when you move to Canada with, let's say, a restricted stock unit, there's going to be some trailing income until all of those units have fully vested that were awarded in let's say, the United States. So you're always going to have some sort of taxable income until those awards are all vested. When it comes to the restricted stock award, unless you've made the 83B election, you're going to have an employment income in the United States that's taxable, but you're not going to have that reciprocal income reported in Canada because for Canadian purposes, it was already taxed, right? The taxing event happened at the grant. So that could, depending on how it goes, it could have an impact on your foreign tax credits. But in that case, if you haven't been living in Canada for all that long, or you're anticipating moving to Canada, you may want to look at what sort of awards you have when they're coming up for vesting and how best to deal with them.
So it's always a great idea to communicate with a cross-border accountant a year in advance, if not sooner. Now, the other thing that really comes up a lot, and I know there's more restrictions around the employee stock purchase plan. So that's just the employee's opportunity to buy stock at a discount with maybe it'd be an Amazon, a Google, Meta, or Facebook. How common are these? And I see that there is a restriction up to $25,000 a year that these, or 15%. Up to 15% of I'm sorry, it would be a discount on the stock price, or there can be. How common are the ESPPs?
They're fairly common. For companies that don't want to have a formal stock option plan, the employee stock purchase plan is an easier way to get employees to invest in the company. In the US, it's very common because a lot of people invest and put it in their 401ks. The $25,000 limitation, that's for US purposes, to have it be a qualified ESPP.
I see.
And a lot of people think that an ESPP is a stock option, but it's really not. It is a stock purchase plan. So what happens is, let's say 15% is withheld from each of your pays. It goes into a pot, and at specific times throughout the year, the purchasing period, whatever's in the pot based on the fair market value, you get your shares. That 15%, usually the safe harbor discount is 15%. So the 15% discount is employment income, right? Because you are getting a benefit. You're getting a share worth, let's say, $100, but you're only paying 85 for it. So that does get taxed, but it also gets added to the cost base, right? So that's important to track as well. A lot of the broker statements that come out of the US typically would only pick up that $85, not the additional income. So you don't want to pay capital gains on something you've already paid tax on. So that's important to track. But the ESPP basically, we have them in Canada as well. In the United States, they can either be qualified or non-qualified. Typically, if they're non-qualified, they're taxed basically at purchase. Qualified, again, they fall under that $25,000 annual threshold. And there's a few other requirements that have to be met. There's a holding period as well for that. And typically, if it's reported out of the US, there is separate reporting that you would get, similar to a 1099 div. You would get reporting on the basis. So those forms, when you get those in January or February, make sure you keep them because they will come into play later on.
This is probably the most complex we ever get into when it comes to these expats living in Canada. And of course, the other one that we have, which is the double taxation of incentive stock options and the fears of being double taxed. So how do you address ISOs?
Yeah, so incentive stock options, that's a US tax concept. In Canada, it doesn't really mean a whole lot. A stock option is a stock option. But from the US perspective, if we look back and just kind of look at what an incentive stock option is, it's a stock option that's issued. And when you exercise it, it has certain conditions that have to be met. But if it's a qualifying exercise, it means that you're basically holding that stock after the exercise for a period of more than 1 year, right? And if you do that, basically what happens is instead of you being taxed on that spread as employment income, it gets taxed at the long-term capital gains rate in the United States. So that could be a difference between 37% federally and 20%, right? So, and you can delay it, right? The incentive stock option does come with a risk of alternative minimum tax, which is a separate issue. But the issue when it comes to moving across the border with the incentive stock options is this. When you move to Canada, they don't care about the holding period, right? They're gonna tax you when you exercise the option. And if you are in Canada when you exercise that incentive stock option, you may not be taxed on that in the United States, but you're going to be taxed on it in Canada. And so there's a mismatch of when you have the foreign tax credits apply. You may be able to claim a foreign tax credit for the alternative minimum tax. But again, that's not going to be based on the regular tax rate. So you may have some leakage there. One way to avoid that mismatch is to disqualify it, and basically doing that, you're selling it within the year, so it does hit your W-2. But one thing that does come up, especially when you're in Canada, is if you have that qualified incentive stock option, be aware that there's zero withholding on that, right? So if you're in Canada you're going to have your taxes withheld in Canada. But you may have a big chunk that you're going to have to pay to either the IRS or the state, because there would be no withholding on that incentive stock option. So that's, there's always the cash flow issues when you're dealing with equity income, especially in a context of working in more than one jurisdiction.
The other thing that we, on one of my notes here is, I'm assuming with the RSUs and the RSAs, are you seeing people transfer them to trying to offset some of the tax, transfer them to RRSPs? And does that line up?
It's not as popular to transfer them to the RSPs as it is in the US to put them in your 401k. As long as the stock's eligible to go into the RSP, that's fine. But usually you have to do the exercise and have that taxation happen outside of the RSP before it goes in, right? So you can't really defer the tax on an employment benefit by putting it into an RSP, but you can certainly offset that by the contribution.
Now, what are some of the common mistakes that you're seeing with these Americans becoming PRs up here in Canada, permanent residents? What are the common mistakes that you're seeing? Because I'm sure we all have stories that can go on for hours. But go ahead. What are you seeing on your side?
The most common is poor record keeping, right? There's an assumption that the employer is just going to take care of it. It's all going to be reported correctly. But don't make that assumption, particularly when you move payroll from the US to Canada. You really have to look at, your pay statements, all of the transactions, the vesting documents, the confirmation transaction statements, to make sure, one, that you're capturing all your income, and two, it's not double counted. So one of the issues that I see a lot is income is reported, it's inflated. One reason is that some people just try and do the tax return themselves and don't realize that there's the cash outlay that you have plus the benefit that's been previously taxed in your income. And that piece is usually what's missing, and it creates more tax than you need to pay. So we get a lot of clients coming to us after the fact to amend returns to kind of true that up a bit.
The other thing I could see, as complicated as this is that when these Americans do come to Canada, they don't properly exit. You say record keeping is very important, but the fact that they're not exiting the country properly, believing that they can use an existing financial advisor, they can have all their non-registered assets. What does that, how much does that create a problem when they start leaving all their accounts in the States?
Yeah, I mean, you have a lot of do-it-yourselfers who want to manage their own assets, and that's one thing, but there are nuances when you cross the border. I've seen numerous times where a client will update their information with a bank or a financial institution in the US. And once they get that Canadian address, we can't handle your account anymore. So when it comes to things like equity compensation, I mean, you may not want to sell or liquidate those shares. Those shares may not be transferable to a bank in Canada. You may have to liquidate and then repurchase. So there's different, depending on who you're working with, there could be a few steps involved. It may not just be a matter of clicking a few links on your computer to have it transferred to Canada. It may cause some taxable events happening. We see it all the time with the retirement accounts, but typically, the thing is too, when you have these global mobility plans and these equity plans, a lot of times the reporting is geared towards the US, but when you get to Canada, we have different reporting structures, right? For example, our capital gains are weighted average, not first in, first out. You get a step up in basis when you move to Canada. That's not reflected on the US reporting. So there's a lot of different aspects of moving across the border that people might not think about. It could save them tax dollars, or it could cost them if they're not aware of these issues.
Well, I know on our end, what we're saying is that, for a person who spent all their working days in the United States on a green card, they surrender the green card or renounce the green card, and then they move back to Canada. There's issues on how you can manage those assets. But when you start getting in these, it seems like the second and third wave of these people that are choosing to work for the Amazons and the Facebooks in Canada. It just takes so much more experience, and that's what we're grateful to have people like yourself that we can work with, because it is overwhelming, not only for a lot of advisors, but the clients themselves. So we definitely need people like yourself. Before we let you go, what's the last thing that you want to you'd like to tell people out there that what they should be concerned about?
Well, there's a lot of things to be concerned about, but one thing I would caution, as with everything, be careful about the water cooler conversations you have. When it comes to tax, each situation is truly different. One small fact could change how someone is taxed in Canada. So I get a lot of calls and people talk, well, my coworker, his situation is the same and he doesn't pay tax in Canada. I don't know what the other situation is, but it can't be the same if you're not paying tax, right? So family plays into it, where you're considered a resident. And those residency issues pop up a lot because people assume I don't have a green card, I'm not taxable in the United States, or I've given up my green card, I'm not taxable in the United States. That's not necessarily the case. You have to dig a little bit deeper, and just do your due diligence, right? Get an opinion, get a second, third opinion if you want. But somebody that's giving you that opinion should be aware of all of the factors, not just your employment situation, but you have to dig into. Unfortunately, we have to get a little personal, and dig into your family situation, where you're living, what how much time you're spending in various countries. It's not always a slam dunk. So try not to get misled by, I haven't been in the US for 183 days, I'm fine. That's that's a falsehood, and it could get you into a lot of trouble.
That brings up a great, when you talk about people around the water cooler, we have so many snowbirds that are going down south, and they're taking immigration, a little bit of immigration, a little bit about tax, the 183-day, having to file the 80/40.
Yeah.
And they take these two little things and they shake it up and they start to serve it to all their friends. And snowbirds, depending on where they came from, if they have that A personality, they know everything. And I'll tell you, there's a lot of this cross-border space is complex. You do need a great cross-border accountant. We know you need a great immigration lawyer, and find yourself a cross-border advisor that's well experienced. So, Sharon, thank you very much for your time. And I always close off by saying, the world is small, be kind to all.
Yep.
And we appreciate what you do for our mutual clients. Thank you very much.
Thank you for having me. It was my pleasure.